And we are pleased to welcome now Jeremy Nelson, partner at Element Wealth. Good to see you again, Jeremy. Thanks for coming in.
Always a pleasure.
Well, I'm just watching the markets today. We have pulled back from the highs of the day. We were up around 200, 220 or so on the Dow. The NASDAQ's still up, I think, over 200 points. At one point was north of 300. And that's because we got some new, fresh CPI data. I was just saying earlier, I'm not so sure how reliable any of that data is anymore because they always come back and revise it, especially the jobs data.
It's always revised. Yeah, the number was a little cool. I mean,
3.3.
I mean, in line with what everyone was expecting. I mean, we quibble over a 0.1 here that we know is going to get revised all the time. Yeah, I mean, bottom line is the inflation's still hanging around. That last little bit is stubborn. But, yeah, when you get into the numbers, there's a lot of revisions, especially as you start looking at how they calculate housing and different things like that. I think, for our listeners, what I like to just say is, I mean, look, simply put, there's still inflation, right? It's not as bad as it was, but the Fed's got to finish the job still.
Yeah, I think they would admit that. So we're expecting something out of Fed Chairman Jerome Powell later today, right? The FOMC?
Yeah.
FOMC's been meeting.
And I think they've been pretty consistent in their messaging. I mean, the market has now kind of digested this idea that, hey, we're not going to get all these rate cuts this year. I remember going into the year, they were talking about, the market was predicting 6 rate cuts, and we talked about it on the show. I'm like, there's no way they're cutting 6 times. I mean,
well, halfway into the year, we hadn't gotten one yet.
So, I think they're going to say the exact same thing, which is we're holding rates where they are. We're encouraged by this. But it's too soon. We need more data to get to a point where we would be comfortable cutting.
Do you still think that they are administering monetary policy consistent with the 2% inflation goal?
Yeah, because I think that they believe that holding here will erode that last little bit. I think that's why they're not cutting, right? Because they recognize that they have to hold rates up here in order to get it back down to that 2%. I think that they also recognize that if they went up and said, hey, it's not going away, we need to go up more, that it would just completely shock the markets and you could create a real mess at that point.
Well, they seem to indicate that's still the goal, the plan, and that 3.3, I've seen some economists say they need to raise the 2% target.
Well, and I just think that that's foolish, right? Because that crushes the average American, right? So if you look at it from this perspective, you go, well, let's just change the target now that we've all, unanimously agreed for a long time that 2% is kind of the target rate. Now, just because we can't finish it off and we want to make the market happy, we're just going to change it. So, and that just leads to bubbles and bigger messes.
It's true.
There's got to be a level of efficacy with what the Fed does and consistency, and I think that they're doing a good job of holding the course right now.
1.2 trillion, that's the deficit year to date. That's 8 months into the Fed's fiscal year, 4 months left. If we annualize that, we're looking at 1.8 trillion. It was 1.7 and change last year, so we're stuck in this almost close to 2 trillion, likely to be there next year.
Janet Yellen would like rates to come down a little bit, right? But the reality is that there's only so much that the Fed can do to bail out bad fiscal policy.
Right.
I remember sitting on a call with Ben Bernanke, during COVID, and that was one of the points that he made. And he just said, look, there's limitations to what you can do with Fed policy. Eventually, fiscal policy has to, get responsible, and that's where we are. The deficits aren't going away, and the Fed can't cut interest rates to eliminate those deficits.
Right. Bernanke, of course, used to be chair of the Fed.
During the financial crisis.
Right. And I think did a fairly good job, honestly, maneuvering that.
I mean, talk about the hardest job in the world.
At that point.
Almost in the history of the country. Right?
Agree.
I
totally agree. In fact, the world economy was relying on his action to a great extent.
Yep.
And then, of course, he was advising, I think, more so than Powell does on some fiscal action that could be taken during that time period as well. But it's something we've talked about. You make a great point there, is that we essentially have the Fed and the federal government contending with each other.
Mm-hmm.
We got the monetary policy of the Fed. We got the fiscal policy of the federal government. And Joe Biden has said, well, I'm relying on the Fed to cure this inflation problem. Well, they got limited tools.
There's literally only so much that the Fed can do, right? I mean, it is still a free market. And, I go back to the old school Milton Friedman mentality, right? Well, if you print a bunch of money, it's going to be inflationary, right? And so when you think about all the handouts and the deficits and just pouring money into people's pockets, that's going to be inflationary. And what we have now, this last 1.3%, is the hangover.
Yeah.
Right. That's what it is. Right? We all got drunk on all the free money, and then the inflation ran up, and then this is the hangover now, and it's not going away.
The 3.3%.
3.3. Sorry.
Yeah. Exactly. And so, but just to clarify for our audience, when the federal government is producing deficits, it is expanding the money supply to pay the bills.
Yeah.
And expanding the money supply is inherently inflationary.
It is. Yeah.
I mean, that's how it works.
Yeah.
More of it out there is worth less.
Yeah. And the 1.3 I meant was the 3.3 minus the 2 target.
Okay,
right?
yeah. Gotcha. We're trying to carve another 1.3 off of this deal. Well, that's really, really hard. From 9 to 3.3, which is where we are now 2 years later, wasn't nearly as hard as this 3.3 to 2.
Well, and that was kind of our point. We've talked about this on the show a lot, where we said, yes, we agreed that a large portion of the inflation initially was transitory, right?
Yeah.
That was what the Fed talked about. They said, well, it's transitory.
Supply chains and stuff like that.
And that was totally understandable. But what we said was it's not all.
Right.
And what's going to happen is we were going to see this period of time where it was going to run down, and now we're at this point where we're seeing what's left over. And this is real, and this is sticky, and this is hard to get rid of.
Yeah. And that's where we are. And so on that basis, I just don't see any rate cuts this year. Do you?
I think at best we get one. I think that we're getting closer and closer to none.
Yeah, agree. Quarter point maybe if we get one.
Tops.
Where are we 5 1/4 right now?
Yeah, we would have to see some serious traction in order to get there for the Fed to pull. So it's not going to happen. Coming up. The Fed's talking here today.
Yeah.
It's not going to happen through the summer. September maybe, but they're not going to want to do it necessarily, as we get into November, because then it's going to be viewed as political, and they want to be as non-political as possible.
Well, and of course Powell wants to keep his job too. Yeah, you may have seen Elizabeth Warren. We probably don't agree with her on like anything from an economic perspective.
Very few things.
But she's demanding that Powell bring the rates down without really thinking about the consequences of doing that.
I mean, that's idiotic, because what does that do? That only helps. I mean, she's anti-Wall Street. That only helps Wall Street.
No doubt about
right?
it.
It doesn't help Main Street. Main Street needs these rates to come down. I mean, all of us that, I put everything on my credit card every month, and I get my credit card bill, and now I go, I haven't bought anything, and how is my credit card this much? I mean, it's to the point where, everyone's really noticing it. But, if you're a lower income or middle income household in this country, you are really feeling it.
Right.
And that's who needs to be helped here. And you've got to get rid of this inflation.
As long as we're running those deficits, you're going to have a hard time with that. The Fed can do whatever the heck they want, but you keep printing money and inflating the currency, the money supply.
Yeah. And this is ultimately going to be the story after the election. Right. So once we get past the election, whoever it is, and I think that you're probably going to see Republican Senate, House is going to be close, presidential race is going to be close, but it's going to be one of those really tight, grindy governments again, no matter what. They're going to have to come up with some sort of a plan to begin to get these deficits under control. I mean, because you're talking about interest on the debt now at the same level as military spending.
$800 plus billion on track to be at $1 trillion. Second only to Social Security in terms of line item spending.
Yeah.
Unbelievable. Interest. And unfortunately, the only way to make that come down are really two ways. One is you got to start paying the debt off. You can't do that until you balance the budget.
Yep.
And then the second thing is interest rates would come down. And Can't really do that until you feel like inflation's under control.
But you also have to grow.
Yeah.
One of the key points here is that
Totally
the economy
agree.
has to continue to grow.
Something we don't hear a lot from this White House or the Democrats. They're not pro-growth. They're always pro-redistribution, pro-recut the pie.
Balance the budget, grow the economy. It'll start taking care of itself.
I totally agree. Well, let's continue this discussion. We got Jeremy Nelson, partner at Element Wealth, in the Element Wealth studio, and we're coming right back. With Jeremy Nelson, partner at Element Wealth. You know, I know we're talking about economics and financial matters and the like, but you can't do that without discussing politics, I should say, and public policy, especially fiscal policy, monetary policy, that emanates from government. This has been a good economy for wealthy people under Joe Biden.
Absolutely.
It's been a great economy. Yeah. So it's a situation where they talk about and they declare that they're a party that is concerned about the average American, and they're constantly chastising and attacking success and wealth and all that sort of stuff, right? But in fact, their policies have hurt the very people they claim to be the champions for, and they've helped the people that they denounce on a regular basis. Is that the truth?
Yeah, I mean, if you think about it, the playbook of the Democratic Party is to play Robin Hood, right? We want to steal from you and we want to give to you over here. Well, we know that redistribution like that isn't good, right? Because it doesn't create jobs, right? What we've got to get to from a fiscal policy perspective is the idea that we have to create an economy that rises the tide, right? And when you have a rising tide, all boats should lift. And we're not at that point right now. And so ultimately, what we need are policies that get put in place that do create a little bit of relief for lower income families. They have been more impacted by the inflation, but more importantly, what are we doing to create opportunities?
Yeah.
What are we doing to raise the wages and their skill level? So this goes in, these are very long-term things, but things like education and all that is very, very important. But getting people into the labor force to better their own situation is the solution.
They never discuss that.
No.
You know, I've described it as they talk a lot about recutting the pie and never talk about expanding the pie. And there's no pro-growth policies as part of the agenda.
Yep.
There's no talk of deregulation or lower taxes or just getting government out of the way. And to me, it's something we've talked about, Jeremy, that has become more common and I guess more prevalent is just the flurry, the barrage of regulations coming from the agency complex that affect our lives more than what comes from Congress, and in particular business.
Well, and if you think about what that regulation does is it creates a cost and a burden on business,
right?
Which means that's less money that business then can go and pay employees, can reinvest to grow, to seek other opportunities.
Take risks.
Yeah. And again, there is a place for appropriate regulation.
Sure.
Right? You don't want the inmates running the asylum. But ultimately, when you over-regulate everything and you create too many rules, too much complexity, then it stifles business. And we talked about it at the end of the last segment. One of the keys to getting things back on track, and we've done this before in this country. We had a lot of debt coming out of World War II. This is not the first time that we've dealt with debt, and I think we will ultimately get through this. I'm actually positive on this. But ultimately, we have to grow. And that's what I think the Democratic Party is missing is, yes, hey, we might have to do some stuff with regard to revenue, especially around Social Security, Medicare. We do have to cut some spending, but we also have to grow. Yeah. So if you can fight at both ends to get that budget balanced, but still support growth in the economy, then all of a sudden that debt becomes less and less of an issue.
It just doesn't seem like that there's a lot of interest in any of that. But I just want to point out that the wealthy people in this country have done pretty well. And just even from under the Biden administration, even from the perspective of the spending causing inflation, causing interest rates to rise, has made low-risk fixed income securities much more lucrative.
Oh, absolutely.
So if you got the cash and the assets to do it, you can go make 5-6% on your money and wipe your hands and done with it.
You can go get a mix of, a little bit of high yield, some corporate, maybe a little EM debt, maybe some treasuries, and a pretty well-balanced fixed income portfolio, and yield 6% now, and people are happy.
Yeah, so that's kind of changed the game. I mean, that's different than the 1% CDs if you park money at a bank.
Now that has implications, right?
Sure.
On markets down the road, because are people going to be more attracted to fixed income securities when all of a sudden they're looking at these nice yields and looking at valuations on equity? So there's some implications there, I think, that people need to be very aware of for the intermediate term for the stock market.
Yeah. One thing I have concerns about, and I'll let you explain this to the audience, that the Fed may do just to try to rein in inflation, is impose what in the economic and investment community is known as a bank tax, which essentially means raising the reserve requirements.
Yep.
Essentially what it does is it parks the money in the bank so it can't get out into the economy and thus inflate.
It cuts off credit.
Right.
And so as soon as you contract credit, that starts contracting the money that's going into the economy. So that is absolutely something that could happen. And we are seeing this even locally to a certain extent. I've got some banker friends who are sitting on their hands right now saying, yeah, we can't lend right now.
So already a little?
It's already.
Okay.
You are already starting to see a little bit of a contraction in credit. Yep.
Okay. So, but if the Fed, and they have the ability to do this because of their relationship with the banks, if they come out and change that, I mean, they do have the control over that, right?
They have 100% control.
That's what I thought. I mean, that doesn't come from Congress. That comes from the Fed because they're responsible for the money supply.
Yep.
So part of that responsibility is a way to, I guess, execute that responsibility. They could impose higher reserve requirements. Explain that to our audience for us.
So basically what happens is, if you're a bank, you take deposits and then you lend them out.
Right. Or invest.
Yep. But what they will do is they will limit how much the banks can lend and make them hold more cash in the bank. So they change that ratio so they can lend less money out.
And the theory, it's not actually a theory, but the purpose of that from an inflation perspective, explain that.
So then you have less credit, which means there's less available money for people to go get to buy stuff.
Yeah. Just keeps it out of circulation, essentially, and it literally is being held in the banks on the balance sheets, and that's thought to have a cooling effect on inflation.
Yeah. It absolutely does. If you can't borrow money to buy that car, or if you can't get that HELOC, or if you're that business and you can't get that loan, then that's money that you would have spent that you're not going to now.
Especially businesses.
Yep.
Especially has an impact on the economy from a business perspective.
And that's where the majority of the impact is. It's easy to get a home equity line of credit. Financing cars isn't a problem.
Mortgage,
right?
chattel mortgages,
But ultimately, it does have a big impact on business lending. Because those are bigger loans that move the needle.
Yeah, and it could affect CapEx, and that affects manufacturing and supply chains and everything that people make to sell to businesses they borrow money to buy.
It can have a major impact on development as well, real estate. So multifamily housing, things like that. I saw a deal that came through my desk recently that was a very creative way to get money into multifamily housing, where investors would come in on the front end. So you're already seeing that the big banks are pulling back on some of these deals. And private credit is kind of stepping in to fill that void. I'm
thinking that ultimately could have a more significant and meaningful impact on inflation than just plain old interest rate and bond buying.
I actually agree wholeheartedly with that, because if you think about what creates inflation, right? It's more money circulating.
Right.
And so if the Fed limits the amount of money that can be lent out and the banks are stagnant, then you're limiting the growth of money, and it's just sitting there, and then people are building up deposits and it's just sitting there. So it does have a major cooling effect.
It's a way to accomplish the same goal without changing interest rates,
Yep.
essentially.
Yep.
Yeah. It's been done before. It's used as a tool, right? It's been done historically.
I mean, for bank safety, they made some of those adjustments after
That's right.
the
crash.
meltdown of Silicon Valley Bank.
Yeah, they sure did. That's right. But big time after 2008, just turned that whole thing upside down.
Dodd-Frank changed the game.
Yeah, completely changed. To the point where, as you remember, the small and mid-sized banks, they couldn't loan money to anybody for anything just about for a while.
Yep.
I mean, it was killing them.
Yep.
Almost seemed like it was by design to some extent.
It was pretty egregious. And then, as always, right, the big banks figure out ways around it.
That's
and,
right.
You know, they're always going to make their money.
Right.
But we talked about this on the show a while ago. You know, the banking system in Mississippi and the small banks in America are one of the things that make the economy great.
Agree.
And we don't need to stifle them.
Totally agree. I totally agree. Well, always good talking to you. Appreciate you coming in. Got off a little bit on a tangent, but it's important to know because that's sitting out there big time and could have an effect.
Major.
Yeah. Appreciate it, Jeremy.
Right.
Thanks a
Gerard.
lot. Yep. Coming right back, folks. We're in the Element Wealth studio. We got half an hour of middays remaining. Stay with us.